I mean, it's early for charts, Dan, but I like this chart because your chart clearly shows that if you compare the S&P 500 with earnings expectations, that we are more attractive. Tell us why.
Well, everybody was concerned that the multiple on the S&P 500 was too high coming into the year, that there were better values in Europe and the emerging markets. That's what everybody was talking about back in January. What we were saying back then was that we just were entering the phase where you would see rapid revenue and earnings growth. So you could, yes, the part of the story was you could have the multiple on the S&P drop, but that didn't really matter because earnings are growing so quickly now that it really doesn't matter, and that's why the S&P is going higher and why individual stocks are doing much better.
Yeah, and if we could bring that chart back up, but if you're listening on the radio, basically it shows that the S&P 500 continues to rise, you know that, but the PE ratio has come down because earnings have gotten so big that the market has not grown as fast as earnings. I guess the question, Dan, is, you know, people say, well, the market grew 9 months ago because the, quote, smart money bought into the earnings then that we're seeing now.
But if you think about it, that phase was actually multiple expansion on the S&P 500 in anticipation of policy changes and accelerated growth in the United States. What is missing is the global coordinated growth story that we thought we might have, that Asia and Europe would do better overall on a coordinated basis. That has not happened.
I mean, the Shanghai market, as we just showed, is at a 4-year low. Now, the stock market is not the economy here, nor in China. But, I mean, what kind of a message is the Chinese stock market sending?
I think there's a lot more pressure, a lot more political pressure on the administration in China to do something. And I think some of the news flow that we're starting to hear today might be a residual of that.
That's an excellent point, as usual, because, you know, we talk a lot about trade and all these other issues, which masks maybe a bigger story that the Chinese economy, while still growing rapidly compared to most other economies, is slowing down.
That's correct. It's
that their debt levels continue to go up, that their currency is falling. All we're talking about is trade, but they've got some structural issues.
Look, Turkey's a sideshow for what's really happening. I mean,
usually
really,
Turkey's the main course.
Yes, exactly. You know, that's an somewhat idiosyncratic. I mean, they're a victim of their own, you know, devices. You know,
well, they were gorging on low interest rate debt for the better part of 20 years.
And the party's over, right? Interest rates are going up in the United States. It's just a matter of time before they begin going up around the world. And I really think that will coincide with perhaps better tax policy in other countries around the world to stimulate, because that's a missing ingredient too to get growth. Then you'll get that global coordinated growth story that we've been looking for. And I think there's a whole other lever to pull going out into 19.
So I probably saved the most important question for last, as I should not have, but do you believe then the U.S. market can continue to rise even if China continues to slow?
Yes.
Are we all connected, or can we, quote, decouple?
Well, I don't think you need decoupling. I think those countries, China has no choice. You take a worker from the farm and bring them to the city, you employ them there. You don't send them back to the farm because you don't have a job for them. Yeah. They have to. They have no choice. They cannot afford political instability. They cannot afford unhappy people because they got a lot of them over there.